Craig, if you can give me just in a few sentences, your ideal client for a multi-peril policy. Your ideal client for an assets or risk policy.
The client doesn't claim a lot.
Okay.
No, only joking, guys. At the end of the day, claims are claims. That's what insurance is there for.
Yes.
So an ideal client, anything in excess of 350 million.
Okay, you're paying 350 million. You've got
Appetite,
350 million rands worth of assets.
Total declared assets.
Yep.
Appetite for large excesses.
Okay, 100,000 or plus.
100,000
each
plus.
and every claim, yeah.
And good risk management.
Good risk management.
Yeah.
And if you don't have good risk management, we will help you with that. Awesome. So in studio today, I've got Craig. Welcome, Insurance Coffee with Nick. Cool. And today we're discussing assets or risk. And if this sounds like Greek to you, it's a different way of insuring your business. Okay. If you've actually got buildings, if you're in construction, mining, if you've got warehouse, you've got fixed assets on the ground, you're doing a manufacturing process, this may be a different way of insuring your business than you traditionally know with a multi-peril policy. So Craig, what's the difference between essentially an assets or risk policy and a multi-peril policy?
So an assets or risk policy is all-inclusive.
Okay.
Everything is included unless specifically excluded. Where your multi-peril policy is a more policy of exclusion. So pretty much you've got to bind every single section as relevant and pertinent to your business.
Okay. So, for me then if I have to translate that, what you're saying is that if I've got an assets or risk policy, just everything's covered unless it's specifically been written in that it's excluded.
Correct, yes.
Whereas if I've got a multi-peril policy, if I don't see it on the schedule,
There's no
it's
cover.
not covered.
Correct.
Okay, quite an interesting concept. So Craig, in terms of how an assets or risk policy is structured, let's talk a little bit about that.
So there could be two options in terms of the way that the policy is structured.
Yep.
You could have a full policy loss limit, which means your total declared asset value is a full cover on the policy. Or in certain instances, depending on the nature of the business, you'll then have what we call a policy loss limit.
Okay. So for example, if I've got R1 billion value in a building or something, but actually I only really feel that we're never going to lose more than 60%. So we then have a loss limit at 600 million.
And again, that comes into the rating perspective. So insurers are cognizant and aware that you're not getting a full policy loss limit. It's a case of now they're taking into consideration from a rating perspective to say, right, we're now reducing the rate because now our maximum exposure is only 60% of that policy in terms of total clear value, and adjust the rate downwards from there.
Okay. And what are some of the other aspects that you want to talk about on this structure?
So just some of the other things that can be included is machinery breakdown, for instance. Generally on your multi-peril policy, it's not included. You've got to go to a specialist where an assets or risk is including machinery breakdown.
Okay.
Electronic equipment breakdown as well, a big thing on the asset side.
Yep.
And then you can also include your yellow plant as part of your assets or risk program.
And also, just circling back to your electronic equipment, it's become a big thing for a lot of factories, mines, construction, and that to actually include their own generation of power, whether it be solar, wind, whatever, a mix of things, and those generally have got a big electronic component to it because it's electrically managed and maintained. So I mean that's also an opportunity to actually have that included in a better way.
And again, you haven't got the limitation of power surge, for instance.
Yes.
Because you've got machinery breakdown, electronic equipment breakdown,
You're covered for
power surge at a wider limit compared to the normal 50,000 Rand conventional.
So how does one determine your asset value, Craig?
So obviously on a normal commercial policy, the guys put a specific sum insured for every section in terms of the buildings,
Okay.
plant and machinery, stock and materials and trade. Whereas an assets policy, we declare buildings combined value, we declare the stock value, we declare the plant and machinery value, we declare the electronic equipment, and we declare the office contents, giving us one total declared value for the assets policy itself.
Okay. All right. So Craig, talk about some of the extensions like capital additions. I mean, what is that?
Yeah, so obviously certain clients go and do change or acquire new plant and equipment or whatever during the course of the period of insurance. And your normal commercial policy doesn't actually allow for that.
So what? So just
You don't
just
have-
for the layman, do I kind of get a miscellaneous limit? So if I haven't phoned and added it,
You
it's
get
there.
a 10 or 20%, so whatever your
Okay.
total declared asset value is,
Yeah.
you get a 10% or 20%, depending on what's negotiated with insurers at the time of issuing the
Okay.
policy.
And so obviously this is not something that you would have on a normal multi-peril policy, because you have to specifically add everything. This comes back to everything's included unless it's excluded. So you have this leeway,
Yeah.
where you have this extra cover that's already built in.
Yeah.
Okay, so I don't have the burden of having to have this this list of all my equipment.
So for instance, you go buy R1 million worth of new servers and PCs. Because you've got the capital additions clause, you don't have to now go and increase your sum insured according to your period of insurance.
Okay, so property in course of construction. We were talking off air about that. So where does that come into play?
So generally, when a client does an alteration or a change to their building, they go
Yeah.
and issue a contractor's all risk policy.
So you need a
However-
CAR. Okay, there we go, guys. Contractors all risk.
So obviously the client doesn't now need to go take out a CAR policy as a once-off if he's doing general upgrades and changes to the building.
So I almost
The
actually have
renovations.
a CAR policy as an extension built in.
It's an inclusion, correct? Yeah.
Okay.
Once ago.
A solidification and material breakout.
So that's a big thing with the mining guys.
Yeah.
At the end of the day, there when the guys are manufacturing their materials and the like, and it now does reach a stage where they close up business, and unfortunately in the crucible, the material cools down, and then they're unable to now break it out, and it's now going to cost them, so they're not able to reuse that material. The asset all risk policy includes that.
Okay, so then you would have damage to the actual crucible or the thing that you were cooling it in or whatever. And now you can then institute a claim.
Correct, yes.
Okay. So Craig, how does someone get hold of you or your department in terms of assets all risk? If this sounds cool,
Click on the link below.
click on that link. Okay, and get a quote from us, guys. So we're going to like and
Subscribe.
Okay. Craig, I want to tell you, we've got this other video here on commercial insurance. I think it might be quite good for the viewers to circle back and see what that is. That's your normal
What's covered in a normal multi-peril policy?
normal multi-peril policy, 100% versus an assets all risk.